Welcome to Deep Into Finance family. We appreciate you being here with us. Give us a like and subscribe to our channel. Share with your friends and family and stay up to date to our future videos. The banking crisis is a term used to describe a period of economic turmoil in the banking sector. It is characterized by a large number of bank failures, the collapse of the banking system, and a significant impact on the broader economy. The most recent banking crisis was the global financial crisis of 2007 to 2008, which had a profound impact on the global economy. The origins of the banking crisis can be traced back to the deregulation of the financial industry in the 1980s and 1990s. This led to the proliferation of complex financial products such as derivatives and subprime mortgages, which were sold to investors around the world. Banks and other financial institutions use these products to increase their profits and expand their businesses. However, the use of these complex financial products also created significant risks. Banks and other financial institutions became highly interconnected, and a problem in one institution could quickly spread to others. Moreover, the use of leverage, or borrowing to increase returns, magnify the risks. As a result, the banking system became highly vulnerable to shocks. The global financial crisis of 2007 to 2008 was triggered by the collapse of the subprime mortgage market in the United States. Many lenders had provided loans to borrowers with poor credit histories, who were unable to repay them when housing prices began to decline. This led to a wave of foreclosures, which in turn caused the value of mortgage-backed securities to plummet. The decline in the value of mortgage-backed securities had a significant impact on the banking system. Many banks had invested heavily in these securities, and the decline in their value caused massive losses. Moreover, the interconnections between banks meant that the problems in the mortgage market quickly spread to other parts of the financial system. The crisis began to escalate in 2008 when several major financial institutions, including Lehman Brothers and Bear Stearns, collapsed. This led to a crisis of confidence in the banking system, and many people began to withdraw their deposits from banks. This, in turn, put pressure on banks' balance sheets, as they were forced to sell assets to meet their obligations. The impact of the crisis was felt around the world. Many countries experienced a sharp decline in economic growth, as businesses were unable to access credit, and consumer confidence declined. Governments around the world responded with a range of measures, including bailouts of failing banks, guarantees of bank deposits, and injections of liquidity into the financial system. The banking crisis had a profound impact on the banking industry. In the aftermath of the crisis, banks faced increased regulatory scrutiny, and many were required to increase their capital buffers to protect against future shocks. Moreover, the crisis led to a wave of consolidation in the banking industry, as weaker banks were acquired by stronger ones. One of the key lessons from the banking crisis is the importance of effective regulation. The deregulation of the financial industry in the 1980s and 1990s was a major contributor to the crisis. Effective regulation can help to prevent the buildup of systemic risks and ensure that banks are better able to withstand shocks. Another lesson from the crisis is the importance of transparency. One of the reasons that the crisis was so severe was that many investors did not fully understand the risks associated with the complex financial products that were being sold. Greater transparency can help to ensure that investors are better informed about the risks that they are taking on. Finally, the crisis highlighted the importance of risk management. Banks and other financial institutions need to have robust risk management systems in place to identify and manage risks effectively. This includes stress testing, which involves simulating extreme scenarios to assess the resilience of banks' balance sheets. The banking crisis of 2007 to 2008 was a period of economic turmoil that had a significant impact on the global economy. The collapse of the subprime mortgage market in the United States, which exposed the risks associated with complex financial products and the interconnectedness of the banking system. The crisis led to a wave of bank failures, a decline in economic growth, and a range of policy responses from governments around the world. The banking crisis also had a lasting impact on public trust in the banking industry. Many people felt that the industry had become too focused on short-term profits and had lost sight of its role in supporting the broader economy. This has led to increased scrutiny of the banking industry and a greater focus on issues such as executive pay, ethical conduct, and social responsibility. In the years since the crisis, there have been significant efforts to reform the banking industry and prevent a repeat of the crisis. Many countries have implemented new regulations designed to strengthen the banking system and prevent the buildup of systemic risks. These regulations include increased capital requirements, improved risk management practices, and more effective oversight by regulators. Despite these efforts, however, there are still concerns about the resilience of the banking system. The global economy remains vulnerable to shocks, and there are still risks associated with complex financial products and the interconnectedness of the banking system. Moreover, there are concerns about the potential impact of emerging risks such as climate change and cybersecurity threats. To address these challenges, there is a need for continued vigilance and reform in the banking industry. This includes ongoing efforts to strengthen regulation and oversight, as well as a renewed focus on risk management and transparency. It also requires a recognition of the broader social and economic role of the banking industry, and a commitment to supporting sustainable economic growth. The banking crisis of 2007 to 2008 was a defining moment in the history of the banking industry. It exposed the risks associated with deregulation and the use of complex financial products, and highlighted the importance of effective regulation, risk management, and transparency. While significant progress has been made in the years since the crisis, there is still work to be done to ensure the resilience of the banking system and support sustainable economic growth.